Good day, my name is Dean Crocker. I'm an equity analyst with the PSG Wealth team, and today I'll be taking you through our latest EIO report completed on Union Pacific. So on the 22nd of July 2021, Union Pacific released the second quarter 21 results. By way of an executive summary, the group reported strong results, benefiting from strong economic turnaround in the US. They did report substantially higher earnings. This was really driven by strong volume growth, which I recall was about 22%. As well as benefiting from pricing gains and improved operating efficiencies. The group has further implemented a share buyback, totaling roughly about 7 billion in expectation. As such, they haven't done 2.7 billion worth of shares yet to date. They then also reported an improvement in the quarterly dividend, increasing it by 10% to $1.07 per share. The group does seem fairly valued, however, and it does seem that the market has priced in the substantial turnaround in the group's earnings. As such, they're sitting on an EV/EBITDA ratio of 14.1 times and a 19.2% premium to historical average. The group is, however, benefiting from a dividend yield of 2 times. Following this, we do feel that the company is fairly valued and, as such, maintain our neutral recommendations for the offshore portfolio. With regards to the event, as I mentioned, so on the 22nd of July, they released the results. They saw a 30% improvement in operating revenue, driven by a 22% improvement in volumes. Operating income was up by nearly 50%, largely driven by improvement in fuel consumption, also off the back of the stronger operating revenue. Diluted earnings per share saw the benefit of all coming through, resulting in a 63% improvement, while the dividends increased by 10%. In terms of the post-COVID environment, they did benefit from the ramp-up in the economy. With the relaxation of a lot of lockdown measures in the US, they've seen a nice improvement in the locomotive productivity, as well as an improvement in the average train length. Then one of the biggest cost drivers was they saw a 3% improvement in the fuel consumption rate. In terms of the impact, so on date of release, the market reacted positively to the results. They were closed 1.08% higher at $219 relative to the Dow Jones, which was only up 0.5%. However, year-to-date, Union Pacific has underperformed the benchmark by 10.8%. The table below does reflect the various performances relative to Dow Jones Global Titan Index, and you can see that over the past 3 years, they actually underperformed the relative benchmark. However, since our last 2020 April results and the report that we released, Union Pacific has underperformed the benchmark by 17.08%. So the assessment, the company remains sound, as financially strong. It has a very strong balance sheet. It's seen a nice improvement in volumes going through, resulting in substantially higher revenues and earnings coming through. The fact that they were able to maintain their cost structures is a sort of testament to the management. And if they can maintain that, you'll continue to see nice, strong results. However, the concern that we have is it does seem that the market has priced in these stronger results and the turnaround in the economy. And as such, the company just does seem a bit fairly priced at the moment, and really and largely due to that, and based on the 19.2% premium to its 5-year average, an 11% discount to its peers, it just doesn't scream cheap at the moment. As such, we maintain our neutral recommendation for the equity portfolio. If you'd like to place a trade, please speak to your financial advisor, or alternatively, you're welcome to speak to the trading desk. Please take note of the disclaimer, and have a good day.